Hello, Mr. Forehand. Welcome back to our studio as we're on video this morning.
Hi there.
Hi there.
How'd I do? Is it close?
It is pretty close.
Okay, I've been working on it.
You're looking good. I think.
I took a shower this week.
Wow. Cleaning up for me.
Yeah, I know. I got a question for you, though.
Yes.
Are we broadcasting from Hampton Roads, Tidewater, or Coastal Virginia? Which one is it?
Yes.
Why do they keep changing? What's the point?
Yeah, and there's even more than that. You've got what? You got Hampton Roads, you got Tidewater, Coastal Virginia, the 757.
Yep.
I've heard it called.
Yep.
I've heard people call it the Virginia Beach area.
The Norfolk area.
We need to figure out.
Somebody needs to make a decision.
Yeah.
And let's all get on the same page.
I wonder if maybe we should have done like what some other, like the Twin Cities in Minnesota, where it's Minneapolis, St. Paul, or Dallas, Fort Worth, or something like that.
Well, those guys, Minneapolis, St. Paul, they need to make a decision too.
Well,
what are they?
That's true too.
Are they Minneapolis or are they St. Paul? What's the point, right?
I guess they're both.
Right.
Would you rather? Who are you backing in this fight? Are you backing Minneapolis or St. Paul?
I'm going to go for Chicago.
You're going to go for Chicago?
Yeah.
Okay, all right.
Yeah, I'm going to be contrarian and just go against both. Right.
I'll have to pick one of the other NFC North teams. I'll go with Detroit. They seem good.
There you go. Right.
Scott Forehand is with us. We're talking money and, whatever comes to mind.
Yep. And, and I spent an hour this morning, and I want to know who ordered all the damn snow, because I spent an hour getting what was originally 12 inches of snow melted down to 4 inches of snow and 2 inches of ice off my car just so I could come in here today. So whoever ordered this, bad idea. It was a mistake.
You got to get a snow
cover.
cover.
You rethink that. Yeah.
You got to get a car cover, man.
I don't know what that is.
I've been hawking this all week.
Oh, yeah?
So I finally broke down before this snowstorm, and I went to Walmart, and I got just a simple $50 car cover. Imagine it like a bed sheet, right? Like it wraps around the corner of the mattress. You wrap it around the four corners of your car. You put that thing there before the snow falls. Then once the snow falls, you just push it off the top of it, take the cover off, boom.
You mean after the snow falls and then melts and becomes ice, and you have a car-shaped ice sheet wrapped around your car?
Not at all, because the material of it, somehow it prevents it from sticking to it.
We do the same kind of thing for our dogs. We put out the sheets in the backyard so the dogs have a place to go during the after the snow's fallen.
Yeah.
Yeah, my wife did that. She put out 2 tarps. She went specifically to Walmart, bought 2 tarps, put them out there, one for the dogs to walk to the grassy area, and another to put over the grassy area so they could have a place to do their business.
Very caring.
Yeah, it was nice.
Very nice.
Yeah. Yet one of them still decides to use the puppy pad. Still.
Well,
and no, honey, if you're listening, that's not me. It's the dog. Right. So, all right. So cool. So we got a bunch of stuff happening. We got a bunch of travel coming up. We got a bunch of appearances coming up. We'll get to that in just a minute.
Yes.
But normally we start the show with a segment about reading the charts and what's happening out there and what's good news and what's bad news.
Of the universe.
There you go,
Mr. Forehand.
It's the state of the charts for this month.
Boom. Let's hear it.
So if you remember last month, we were talking about how everything was looking great and everything was on the up, and there were some of the charts that were kind of mixed signal charts, and some of them were specifically, we've definitely got an explosive move coming in the positive. Well, true to form, it has since reversed a little bit, and I think a lot of that was probably in the beginning of the honeymoon with the new president, and it's going to continue. Usually, that honeymoon lasts 6 weeks to 9 weeks, so we'll see what happens. But the first thing that I look at. Well, the first thing I looked at this time, okay, because I do change around a little bit, was talking about, let's see.
He's deciding which chart to start with. There's so much good information here.
I don't know what words to use to describe this chart, because it's a control chart. And what that means is I've got a group of equity stocks that are always in this one group, always. And they're a mixture of blue chip, mid cap, small cap stocks. And as a control, that means if the only thing that's ever in there is the ones that I start with, and it never changes, then that's a real easy way to determine, as long as that's a diversified control group mix, that's an easy way to compare that to the rest of the market. And when I look at the control group stocks, we've had in the last 3 years, 2 drops. And the 2 drops were less than 0.2% when they had the drop. Okay? So that's kind of good. Actually, no, hold on. Let me recount. I've got 2 drops that were at 0.2%, 1 drop that was up 0.1%, 1 drop that was up 0.3%. Okay. We just had a drop of 0.8. That's the biggest drop since I've been tracking this control group, that's not good. There was only one. Actually, there was one other time it was worse, and that was the big drop in January of 22, where the drop. If anybody remembers what that was the herald of a 19.6% reduction in the market value for that year, and that drop was at 1.2. So we are at 75% of the equivalent of that drop, which means if it holds true, and apples being apples, then we're looking at somewhere around for this year a net drop of around 12 to 13%. And that kind of falls right in line with what we've been talking about, a market correction that's overdue. The market correction which you normally see is going to be somewhere between 12 and 20%. And that falls right in that line. We're still 4 years, almost 5 years now overdue for that big market drop, but we'll see what happens. And that drop that we had in 22, if you recall, we had an almost immediate recovery, which is actually not good. And the reason why it's not good is because that means that drop was false. It wasn't a real correction. It was just people taking some profit off the tables and putting their money in other places. It wasn't a real correction in the market. The market is still overbought. Jamie Dimon, 27%. There's equity positions out there that are 27% overbought. And that's a scary place for us to be. It is the herald of a big drop that's going to happen at some point. I don't know what's going to cause it, but I said this. I've been saying this for months, and I don't mean to be doom and gloom. If I see positive stuff, I'll say positive stuff. Next, here's a positive thing: the industrial production. The U.S. industrial production has been in a laggard for the last 2.5 years. We've been below where we should have been, below where we've been historically. And actually what just happened is for the first time in 2.5 years, we've actually hit the level that we should be at. We are right even with from an industrial production perspective where we should be. That's a good thing. That side of the economy, or that one facet of the economy, is coming back to where it should be. That's good news, right? Here's bad news. Okay, so the Fed does a study every quarter about what the wage growth is for each area that the Fed controls: Atlanta Fed, Pennsylvania, Philadelphia Fed, and so on. And the Atlanta Fed did a study, and they just finished it, and they've been tracking the wage growth. Okay, not wages, but wage growth. They've been tracking wage growth for years and years and years. And if you look at the last time when we reached a pinnacle of wage growth, it would have been in September of 22. All right, so we've had a steady decline in wage growth since September of 22. Every month has been slightly less than the previous month, with 2 exceptions. This isn't good. So while we've got some unemployment numbers that are coming back that are favorable, we also have a reduction in what people are earning, and inflation's not stopping. So as people are earning less and inflation continues to go up, that means there's the chasm between what they earn and what they can spend becomes larger and larger. They've got less and less that they can use. So it gets to the point where now you go to the grocery store and you do have to make a decision of whether or not you're going to buy that name brand thing or that off-label thing or the store brand thing. Not saying that the store brand thing is a lesser quality. I'm just saying it's going to be cheaper. So that, and then when people get to that point, then this other stuff that people are really missing the boat on, which is what this whole show is about, and investing in retirement, that goes by the wayside. When people are just worried about whether or not they can buy the brand name of XYZ or the generic XYZ, they're not thinking about what's going to happen to them 30 years, 40 years down the road, and that's a problem. All right. So it's certainly a problem for my industry, but it's a problem for them whether they realize it or not. A couple other things to take a look at. There's a lot of changes in the job market now. People are switching jobs. People are, if you look at what's happening within the federal government, all those guys that have been, regardless of what side politically you're on, all those folks that have been taking money and earning their money and had a relatively cushy job, they're having to look for something. And when they go into corporate America, they're going to have a moment of an epiphany about what it really means to work, because the corporate America doesn't play the games that the federal government does. And so when I take a look at what's happening with those people's wages, which on a recent history and even long-term history, government workers and government employees, whether it's DOD with military or whether it's people that work civil service, these folks have good, solid retirement systems that are built in, and that they are the last bastion of that. You don't see the 401s and the 403s like you did before. Before you could sometimes see people that would have a 401k with a 10% match at the corporate level, and you don't see that now. And what you see now is, we've got a 401k. You're eligible to contribute to it if you like. What's my match? We don't match. That's the norm now, what you're seeing with corporate America. So when all these folks that are coming out of these federal government and civil service jobs get into the real job market, they're in for an awakening, unfortunately for them. And this is certainly, when you take into consideration what happens with the reduced additions to their retirement systems when they move into the private sector, when you take that into consideration, then you have nothing but a drop. And we've been seeing this since, again, September of 22, a consistent average drop in people's wages as people switch jobs. They're switching jobs because maybe they think the grass is greener on the other side of the fence, or maybe because they don't have a choice. But either way, their return, their gain, the move doesn't give them the financial result that they think it does. And that's unfortunate. Unless there's other factors like, I'm taking this job, I'm going to make $10,000 less per year, but I'm not having to spend 2 hours a day driving anymore. Okay, that's the other thing that we see now. There was a pushback for a while of people working jobs that were remote, and that people were encouraged to work remote even with COVID. And there were some studies that were done that said that people that are working remotely are as productive as people that are not working remotely. And then there were lots of studies done that proved exactly the opposite. So when we get into that discussion of whether it's better for the individual, it's probably better for the individual to work remotely. But when you take into consideration the corporate expectations, that's why corporations are pushing people back. Again, I go back to Jamie Dimon, what he's doing with that group. They're if you don't want to work here in our office, no problem, go find a new job. And that's going to be, I think, kind of the rule of the land here for a little while. And the last thing I want to look at, actually I got two more. S&P 500. So this is good. The S&P 500 has been on a run, really, since COVID, since the end of COVID. And that's great, except when the gas has run out of the vehicle. You're going to see this. It's called a staccato trading pattern. You're going to see this up, down, up, down, up, down, really, really fast, moves up and down and up and down. And none of them are going to be great. They're not going to be these big, broad, sweeping moves. They're going to be small. But in the end, if you pull back and you take a look at what it is really happening, this up, down, up, down, up, down, it's not showing that upward trend anymore. It's showing a leveling. So if you pull way back, it's actually the beginning of the formation of what we call a head and shoulders pattern, where you see this downward move a little bit, then you see a big upward move, then you see a downward move, then you see a small upward move, and then you see a big, huge drop. That's where we are right now. We're on that little tiny move back up. We've already seen the pinnacle. We're on that little tiny move back up, and then if it follows the standard pattern, we should see a downturn, and it should be a pretty large one. That statement that I just made, it's easy to make. It's hard to confirm, though, until it's actually happening. There are some types of charts that you can look at and you can read that do talk about future forecasting. And one of the ones we look at forecasting is we can kind of gauge what's been happening using a technical composite for the last 2 years, 3 years, 4 years, 5 years. And that's a pretty good indicator of what should be happening as far as a move, when it happens, and how large that move is. And where we are right this minute, we are seeing this bouncing at the top of what the range should be for the technical composite. It's not going up too much. It's not going too far above this line that we've set as a ceiling for where we should be. But we are seeing this beginning of this pattern where we see up, down, up, down, up, down, moving between the middle of where the number should run and the top of where the number should run. And we're bouncing on the top. And that means that the point of resistance is too strong for us to get through. And when you have the big market, the big money folks that are out there, the hedge fund guys and the big money managers, those guys, when they get into this position, it's an alarm bell for them going off. It's time to take profit. And that is going to be part of what happens when the downturn happens. And the downturn is going to happen, and it's going to go down. And the first test is going to be that middle of the run. We've made that test in the last 12 months 1, 2, 3, 4, 5 times. We've tested it 5 times. In 5 times, it bounced off that middle and bounced back up. That's good news. Where we see it pushing through, it doesn't push through a little. It's going to go all the way to the bottom and then probably go below it. And that's going to be a true correction. The last time we saw that was 2008, I think. It's been a while. So that's kind of the news from the charts. You got some good news. You got some bad news. It's still, I say it's a mixed bag. There's different things that you can assign different values to and different weights. It's up to you what you use. But for me, I'm more of a cautious, conservative investor, for me at my age, when I'm looking at retirement, I'm in my mid to late 50s. I'm not putting too much money at risk, and I'm really more concerned about the return of my money than a return on my money, and that's why when we start looking at people, when you get to my age, 57, you should start thinking about what it looks like to start taking some money off the table. I don't mean taking profits. I mean taking money off the table so that it can't be in a loss position. And when you're in any kind of traditional retirement program, a 401k, a 403b, a SEP, KEO, and even some of the FERS and the state retirement systems that are out there, there's a law called ERISA, ERISA. And ERISA came about because of what happened with Enron. And if you've been around long enough to know that name of that company, then you understand. And you probably had friends just like I did that lost most of their life savings because of Enron, because they had all their money tied up in their 401k. And when Enron tanked and the money managers had all their money invested in Enron, the people with their money in those retirement programs couldn't move it. They didn't have control over it. And when the dust settled, they had lost 30, 40, 50% of the value of their retirement programs. And unfortunately for them, and I know a lot of them here, even locally in Southeast Virginia or coastal Virginia or whatever we're calling it these days, right? Right? I know a lot of those people, you ended up seeing them taking just crazy jobs just to make ends meet, just because they knew that at that point, their retirement plan that they had saved their entire lives wasn't going to be there for them. It wasn't going to last as long as their planners or advisors had told them it was. They were having to pull too much money out of there to be able to make it sustainable, and they had to do something else. So the something else is add more money to it. You can't do that if you're not working, or take less money from it. And the only way to do that latter part, take less money from it, was to go get another job. And so you saw this large number of people moving to just doing just random hourly wage jobs, like taking a job at the ABC store, or taking a job at Walmart and becoming a Walmart greeter or whatever, okay? And it's not that these are bad things. It's still employment. It's still work, and it still serves a purpose. And it probably gives those those folks sometimes, some exposure to other human beings. But in the end, the problem is they didn't have a choice. And they didn't have a choice because they made the wrong choice or because they were a victim of not having moved their money when they should have. So that's why when I start talking to people about their retirement plans and about their future and their goals and what they want, it starts with a when do you want to retire conversation. It's not how much money do you have. It's when do you want to retire. And then we have to work the numbers backwards. How much when we do that gap analysis of people's incomes, how much do you want to be making at a specific time in the future? How much of that is going to be supported by Social Security if Social Security is still performing the way that it is right this minute, which it probably is not as of 2034 at this point. So we have to make these plans. And then we have to be realistic. If you've got $300,000 in an IRA and you're retiring in 2 years and you're used to making $60,000 a year, how long is it going to last you? And it's not going to last you as long as you think it is. And it's going to be, I would say, in that particular example, most likely probably less than maybe 7. And that's kind of the problem, is that the people, they haven't planned appropriately and they've become too ingrained or too focused on what the retirement planning model said to do with diversification and all that, which I do believe in, but with the standard retirement model plan that was built in the 1950s. That's old stuff. It's 70 years old at this point, and change happens. And either you can choose to change or you can choose to be bowled over by change. And that's kind of where I teach this and I beat this drum every time I'm on this show. People need to be moving their money if they're close to retirement. They need to be moving it out of risk positions, and they need to be putting it someplace where if the market goes sideways or down, it doesn't impact them. And when that sideways, let's talk about that for a second. If the market's going sideways and your money's in the market, either through an equity position, a direct equity position, or through an indexed position where you move up and down with the index, did you lose any money? And the layperson's going to say, no, the market went sideways. I didn't lose anything. And I'm going to say, yeah, you're wrong. You did. You lost. You lost 3%. What? Yep, you lost 3%, because that's what inflation is. And that's really not what it is right now. It's a little bit higher than that. So if you're not making whatever inflation is making, then you're going backwards. And you can't afford that. And that number becomes exacerbated when you actually have a loss. So if you're in your plan and your plan lost 1%, did it really lose 1%? No, it lost 4%. And then next year when it comes back 4%, are you happy? Maybe, but you shouldn't be, because you lost 4%. You went down 1%, and then you lost the 4% for inflation. So that means you're at -5%. And then the next year you come back 4%. So you're at +4. So -5 plus 4 means you're still at -1, but then you lost 4 again because of inflation. So if you're not making 6-7%, then you're going backwards. And unfortunately, standard financial planning stuff that we look at it's based on the S&P performance. And the S&P average over the last 20 years is 5.8, 5.9%, depending on what metric you're looking at. And that's before you take into consideration loss from inflation and taxes. And if you're in a position where your entire retirement is taxable, you're probably going to lose, and it's not going to last as long as you think it is, or you're going to have to take less than what you think you're going to take, or less than you want to take. So the lesson for all this is simply this: if you've got money in an IRA, any kind of IRA, 401k, 403b, TSP, 457, whatever, if you've got money in any kind of IRA and you're close to retirement, meaning 59 and a half or older, you should be taking some of that money and moving it elsewhere. Traditionally, the sum of it, what I would use is somewhere between 60 and 70%. But this is on a case-by-case basis, and we'll take a look at it. That's the first part. The second part is taxes, right? How do we eliminate or reduce taxes? And I think, Lee, we're going to talk about that in the next segment.
Sounds good to me. Here with Scott Forehand from the Forehand Agency. His new website, go check it out. It's new, it's shiny, looks good. Forehandagency.com is that website. You can call him 757-278-1264 or 800-677-0989. If anybody would like to attend your upcoming events, of course, you've got the Zoom Infinite Banking class. That'll be on Thursday the 27th. Before that, though, you actually have an event, a retirement and agency building class on this Wednesday, the 26th. Are you going to be in Addison, Texas? Yep. That's how that's going to work?
Yep. It's an in-person event.
At the National Life Group headquarters in Addison, Texas. So you're going to Texas.
I am going to Texas.
You got a cowboy hat?
I do have a cowboy hat.
All good to go?
It's a black hat.
Okay. That's a sight to see.
Yeah.
So if people want to find more information, they can just call you up, right?
Yep.
And they should call you up and tell you they're going to be there, so that way there's space for them.
Right. And that event, I think we had seating for 125, and I know that they've already sold that out.
Ooh, okay.
But I also know that only about 80% of the people that say they're going to be there show up, so we overbook a little bit on that. So there's still a little bit of room, probably.
So if people want to get more information, call you. 757-278-1264, 800-677-0989, or the new website, forehandagency.com. Also, by the way, on that new website, you're going to have the podcast of these shows.
Sure.
Which is nice.
We started that last month, so that new website went live about 3 weeks ago. So it's going to have a repository of all the shows that we do here and all the other places that we do stuff. There's going to be excerpts from the book that you can download and read if you'd like. There's an investment calculator on there, which is really cool. That takes into consideration some of the things that I'm talking about, which is the power of loss due to inflation and things like that. So you can look at, for example, if I put $10,000 of an investment into a vehicle that is going to earn 5%, and I'm going to add $100 a month, what's it worth in 20 years? So that's the kind of tool that a lot of people need. There's an equation that we're taught how to compute that information. That's all that calculator is that equation. And it's what we use as a kind of a mainstay in the financial planning market. And there's a lot of just great information. That's a work in progress. We've got a lot of stuff planned for it in different phases of the website as we move forward in time. But there's also if you're interested in booking an appointment with me or one of my staff, you can do it directly through the calendar. And also we're hiring. So if you're looking at coming into this industry and want somebody to help guide you through the minefield that is getting started in the financial planning business, we can help you with that too.
So check out the website, forehandagency.com.
And we've got one more event coming up.
In Orlando, which will be in early March.
March the
4th.
2nd. I'm there March the 2nd, but the date is March the 4th, Tuesday.
Perfect.
Yep.
And that is a retirement strategy class that we'll be doing down in Orlando. March 4th, 2025.
Seating for maybe 200, 250 there. So that one is not free. That's the only one that's not free. So if you want to go to that class, there is a fee.
Okay.
All right, some other stuff.
We teased everybody.
We did, but I got one more thing I got to say before I forget.
Okay.
I did not put this on our plan for the day. I mentioned that our corporation got written up by Forbes magazine, right?
Yes.
I mentioned that about 2 months ago. Well, we just got an award. Okay.
Oh.
Yes, we are the InsurTech Company of the Year, meaning of all the companies out there that are producing insurance technology products and even insurance, insurance plans, because we are now to the point where we can actually produce our own insurance policy types. We got the number one. We were awarded the number one of everything, which was pretty cool. So thank you very much. Thank you. Go ahead.
Nicely done, sir.
Generally, take a bow. Right. So when I mentioned that we were hiring, that's the kind of stuff that I wanted people to understand that we are. Number one, the positions that we hire and train for, these are high-paying jobs. None of these things that we do start at less than six figures, and you can do them from anywhere in the country. As a matter of fact, I did business 2 years ago from a cruise ship in Miami before the cruise ship left the port. So you can do these from anywhere, and it's really cool. And and the fact that we've got the technology and we are really about 3 or 4 years ahead of the industry of everything else that's available out there. It's kind of an amazing position. We've got great jobs, great support, great training, and now we've got great technology that's way ahead of everybody else. It's pretty cool.
Very.
Yep. So
well, look at you guys.
Yeah, we're rolling. So now the T's.
The T's.
Tax exempt, right?
Tax exempt.
Taxes. So here's the thing.
17%.
Right. That's the number, right?
Here we go.
So here's the thing. If you pick any vehicle, any one thing, it's going to have a specific number behind it that maybe can earn you. And there is nothing out there that's going to say they're going to earn you a 17% tax exempt return. Or is there? So here's the thing. There isn't a one-stop solution. All these solutions that we do, these are designed based on individual need. No two programs are the same. Everything is unique for the client. But there are ways that you can do have dollars work for you in more than one place at the same time. And so that strategy that I mentioned is, let's say you put money in a life insurance product that earns a tax-exempt return, and that tax-exempt return is 8% per year. And you take a little bit of that money and move it into another tax-exempt product that earns 3% per year, and move it a net 3%, not total 3, but net 3, and then move it into another one. So if you can continue to move these programs, move the money and having them in multiple places, then you can get to that 17% number. And we have a program that does exactly that if it's appropriate for the client. Now, there are some restrictions. I think you heard another advertiser on this station earlier this morning talk about using some strategy, and he mentioned a type of Roth, which I do like Roths, but I like a different style of Roth better than the one that he was talking about. But that's great, okay? The problem is it's a one-trick pony. And for the solution that if you have a solution where your main or only return or gain is based on the performance of one thing, one stock, one equity, one index, that's the problem. You're not diversified. Like I mentioned early in the show, I do believe in diversification, and that's an issue with some of those other programs. And where we are with the program, it's not that it will produce 17%. That's the ceiling. There's also a minimum, and the minimum is 11. And that's pretty damn strong. You know, if I've got something that'll produce 11 to 17% tax-exempt returns, and I can touch the money whenever I want for whatever I want without having IRS restrictions of you're not old enough to touch it, or you're too old, now you need to start touching it and take required mandatory distributions, I'm a winner, and that wins. And that's why I talk to a lot of people, and they're just, I've had my financial advisor for 40 years. Okay, that's great. I'm glad you feel that you have a good relationship. And he's never done me wrong. Well, that your definition of never done me wrong is that maybe he didn't lose you money. Did he not make as much money for you as he could have? And if you consider I could have been making 12%, but I'm happy with my current advisor making me 5.5 or 6, I would say you're losing money. And I would say your advisor isn't doing what he or she should be doing for you. Maybe this also comes down to risk tolerance, and that's a conversation that you should have, or we should have. But that's kind of where we look at. So our programs that we try to do here at our organization are focused on not just how much money can we make for you, it's how much money can we keep you from losing, and then how do we keep you from losing it? We keep you from losing it by reducing the amount that you're going to pay in taxes. We keep you from losing it by not being in positions where you're going to have a loss, and that's that private pension side of what we do. And then we keep you in a relatively liquid position so that if that emergency thing comes up, you don't have to take a penalty from your 401k because you took money out of it too soon. Or you don't, or if it's a medical reason, then you'd be fine. But you don't have to. Maybe the emergency isn't a medical thing. Maybe the emergency is I didn't have the right kind of insurance, and my roof just collapsed because I had 1.5 feet of snow on it, and I now have to pay for it. But they're considering that a weather event, and that isn't covered by my insurance program. So I need $20,000 to repair my roof. I've got $2,000 in my checking account. What do? Do I go take it out of my 401k? You need a roof, so the answer is yes. But what are you doing? $20,000, that didn't cost you $20,000. It cost you $20,000 plus the tax, plus the pre-withdrawal penalty, plus all that downline interest that you are now missing. So what if there was a better way? And that would be this other thing, that this class we've got coming up on Thursday, this infinite banking class. That's what that's about. That's about having your money and being able to use it at the same time. There's no investment on the planet that you can do that with right now. Nothing. There's no place where you can put money in an interest and dividend earning position and still access it the very next day and still have it earning interest and a dividend. Why? Because you're not using your money. You're using your money as collateral, and you're borrowing against your money. And then if you engineer it correctly, you'll still get arbitrage, meaning you're still going to earn more interest and a dividend on the money than it's costing you to borrow against your money. And that's part of our strategies that we employ here. We're just trying to put you in a better financial position where you don't have to worry about whether or not you're going to run out of money. You don't have to worry about whether or not you're going to have to start eating tuna fish and ramen. Not that there's anything wrong with tuna fish and ramen. I love tuna fish and ramen. Okay? But you don't want to have to eat that. You want to have the choice to eat that. And that's what this is about. It's a better quality of life, a better quality of retirement. And some people that I talk to, they'll say, when are you going to retire? And they'll say, I don't know, I'm probably going to have to work forever. Okay. Do you want to work forever, or do you have to work forever? And that's kind of where, sometimes people aren't familiar. They have a choice. And I'm not saying everybody does either, because it depends on when you start. But if you start in your 50s, early to mid 50s, you can retire when you want to with 4 or 5 years of appropriate types and styles of investing. If you start when you're 40s, you can retire by 50. If you start when you're 30s, you could retire in your 40s if you do it right. And the answer is most likely not a 401k. The 401k, this is Ted Brenna, the guy that invented the 401k. The 401k is not all that it's meant to be. It's not being used the way it was designed. It's not being taxed the way that it was originally planned. And the interest rates that make a 401k work, 17, 18, 20%, are not common like they were back in the 60s and 70s when they were developed. So there's the problem. We've all been fed a line that was true and accurate for a period of time. But the one thing that I know about life at this point is that change happens. And you can either decide to change with the change, or you can get bowled over by the change. And unfortunately, if you don't know which person you are, by the time you figure it out, if you're the bowled over person, it's too late. And that's the unfortunate truth.
Last time you were here, I remember you telling me a story about somebody, I want to say he was in his 20s.
Yeah.
And he basically is set up to retire already.
Yeah.
Because he played his cards so well using some of these strategies.
Yep.
You've got a lot of stories like that.
Oh, yeah. I mean, that's not anyone. There's probably the exact person I was thinking about at that time. But we've got 50, 100 people that are in their 20s and 30s that are doing these programs now that they'll be able to retire in their 40s. Or one of my clients, we were talking the other day, his goal is not to retire. He likes to work. He wants to work. And he wants to work with his hands as long as he can. So his plan is to get out of the IT world that he's in right now, making good money, but he's living like a Spartan at this point. So he's making $220,000 a year, but he's only spending like he's making $50,000. Okay, so he's got a comfortable life at 20 years old. No kids to speak of. Not to speak of. He doesn't have any children yet. He's got 2 dogs and a girlfriend. Okay, yeah. So where he's going to be though with the numbers, and this is the beautiful part about this, is the programs that we're using for him, they're not subject to market oscillation. So I don't care for him. It doesn't matter whether the market goes up, down, or sideways. We know exactly how much money he's going to have at any specific time in the future. And we know exactly his plan is made. We know exactly at what point he's going to buy 22 acres of land. 22 because he wants 20 acres for growing and 2 acres to live on. That's his plan. And we know where that land is going to be. And we know with a pretty good guess of what it's going to cost. And then he's going to build that thing that he likes to do, which is by that time, there's certain types of substances that are, for a lot of the country, illegal at this point still, at least by federal law. And by then, federal law should have changed, as most state laws are changing. And he's going to have a massive farm. And he's going to be a producer of products. This is his plan that are, it's a new industry. It's not new, but it's a new legal industry.
Sure.
And that's his plan. And I think his plan is a solid one, and he's going to do very well. And at that point, his exit strategy is also built. He plans to take the money now, build this thing, build this business, and then grow that business, and then step off, that's the exit strategy. Anytime you have a business, the two things you have to have are a business plan to get started running and profitable, and then a business plan to exit. What is your exit strategy? So this is all planned out for him. And it's going to work, with in absence of a banking collapse, it's going to work. And that's the beauty of this stuff. If you plan far enough in advance, then you're going to be good to go. And that's the problem with a lot of young people. They're worried about the day-to-day. They're worried about today. I'm just looking, I can't wait till I get off to go have that pizza. They're looking 6-8 hours in the future. They're not looking 10-20 years in the future. And what they don't, and this is, as an older person having lived life, that whole I wish I knew then what I know now kind of a mentality comes out.
Sure.
Right? So that's the thing. And it's not you can never start too young. I think you heard earlier this morning a gentleman talk about investing in some crypto stuff and how because of the minuteness of how a single coin could be broken up, anybody can get it at any level. That's true, right? Okay. You can do the same thing with what we do. $25, $50 a month. That's all it takes to get started. And the only thing is getting started. When do you pull the trigger? And I would say as soon as possible.
And if you want to get started, call him up. Scott Forehand, 757-278-1264. His Hampton Roads Tidewater 757 number. That is 757-278-1264. Nationwide, 800-677-0989. Once again, multiple events coming up. You have on Wednesday, February 26th, down in Addison, Texas, at the National Life Group headquarters, teaching a retirement and agency building class. Also Thursday, you're going to be doing a Zoom class on infinite banking. That is this Thursday, February 27th. If anybody wants the invite to that, they can call you up, 757-278-1264. You've got the online hiring event. That's coming up this week as well. That'll be on Monday, the 24th, and on Zoom.
At 6 p.m.
At 6 p.m. And coming up in early March, a retirement strategy class down in Orlando. So you're going to be busy over the next week or two, aren't you?
Yep.
And if anybody wants these details, once again, call them up, 757-278-1264, 800-677-0989, or check out the new website, forehandagency.com. What do you think, Scott Forehand?
Lee, I think it's a beautiful day. I'm looking out over the battleship Wisconsin and the majesty that actually is that ship. It's an amazing, amazing feat of engineering. And I'm happy to be here. And hopefully everybody gets out of their retirement what they hope to get. And if you have a question about that, give us a call.
See you soon, buddy. Always good to have you in the studio.
Yes, sir.